Hello, and a big welcome to our Providence Financial friends and family. I'm Anthony Saccaro, president of both Providence Financial and Anthony Saccaro Law. And periodically, I like to do a market update or some type of update via YouTube, and that's what we're going to do today. I feel like it's been a while since I've actually done a YouTube video, so I'm glad to be back on and be able to say hello to you all. But let me explain and let me tell you what this YouTube is going to cover so you can determine if it's something that makes sense for you to watch. So there are 5 things that we're going to talk about in this video. First, I'm going to do a quick market update. Second, we're going to talk about or answer the question, will there be an emergency rate cut? The third thing we're going to talk about is the difference between value stock and growth stock, because most of you or a lot of you have value stock in your portfolio. So there's a difference. You need to know what it is. Fourth, we're going to talk about how the recent market sell-off has affected your annuities. And number 5, do you need to do anything? What do you do at this point? So that's what we're going to talk about. If you're a client of ours, which is what these videos are for, thank you so much for your trust. Thank you for your business. We don't take it lightly. Now, I want to start by saying that we have received exactly 0 phone calls. So we've had no concerned clients. And I think we really shouldn't be, because quite frankly, although the media makes a big deal of what's going on, and although it feels like a big deal, the reality is it's not a big deal. This is just a little blip on the radar. The question is, will it become a big deal? Well, that we don't know, but right now it is not a big deal whatsoever. I just did a live podcast interview earlier today and talked about the fact that it's not a big deal. But let's talk about where we are real quick. And first of all, before we even talk about where we are, let's talk about why this sell-off occurred. It all came down to the jobs report that was released just last week. The fact is that the jobs report was expected to come in at 185,000, and it actually came in at 114,000. So a very, very large miss. That means that there are less jobs available than were planned initially. And compare that 114,000 jobs available to June, there were 169,000 jobs available. So the numbers come way down. The jobs available has become way down. That means unemployment's gone way up. And the fact is that right now unemployment rate's 4.3%. So that is what triggered this sell-off. Why? Well, what's that domino effect? Well, we are in a consumer-driven economy. 70% of the United States GDP, gross domestic product, is based on consumption. So the reality is that if the consumer spends money, the economy is strong. If the consumer quits spending money, then the economy weakens, and that's exactly what happens. If the unemployment rate goes up, less people are working. If less people are working, there's going to be less people spending money, and that domino effect means that if less people are spending money, there's going to be less revenue for corporations. Less revenue equals less profits. Less profits means that the share price is going to drop, and that's what's kind of happened across the board. So it's all based on the consumer, and the consumer is weakening. The consumer success over the last few years has all been based on the labor market. The labor market's been very strong. COVID created a supply-demand shortage when it comes to laborers. There are a lot of people in COVID that decided to retire. They were just done. They weren't going to retire. They didn't have plans to retire, but they decided to retire, so they exited the workforce. There are a lot of stay-at-home spouses, whether it's moms or dads, that decided to stay at home through that process, so they exited the workforce. So what you wound up having is workers, but more workers available than there were jobs. And if you go back 2 years, I remember reporting I think to you, and maybe even on live TV, definitely on live TV, along with my radio show and so on. I remember reporting that there was a 1.9 jobs available for every worker. 1.9 jobs for workers. So there's a shortage of workers and an excess supply of jobs. So this made it an employees market, a workers market. Well, that's come down. The most recent reading is 1.3 jobs per worker, and that's more realistic. That's more in line with what we want. So the labor market's been very strong. That's the reason that we haven't had a recession yet. Is because that labor market's been so strong. We've been talking about a recession now for 2 years. It's been the recession that has never come. But I've been mentioning for the last 6 months, if you go to our website, ProvidenceFinancialInc.com, and you look at the media interviews that I've done, they're all there under the media tab. You go back 6 months and you're going to start seeing me say things like, we're not out of the woods yet. We're not out of the woods yet. We could have another recession. And I talk about some of the reasons why that is. But the fact is, it's all hinged on the consumer, and the strength of the consumer is all hinged on the job market, the labor market. The labor market's weakened, so the consumer is weakening, which is further exemplified by the fact that consumer debt's going up, consumer savings are going down, delinquency rates are on the rise. So the consumer is getting weaker, and as goes the consumer, as goes the economy, as goes the economy, as goes the stock market. So it's all just that domino effect. So that's what's happening now. Now, with that said, if you take a look at the S&P 500, the S&P 500 was up 16% until July 16th, I believe. Yes, until July 16th. And now the S&P 500 has given half of it back, so it's down about 8.5% since July 16th. Not really a big deal, right? Would you say that that's panic? The fact that the market was up 16% in the first 6 months of the year, and now it's down by 8%, so we're still up 8%. Is that time to panic? Does that sound like a time to panic for you? Not at all. It's not. But, you'll hear the media talking, and it could be something that, people start to panic about. Again, we've not gotten any calls because I put out videos like this, and so far no one is panicking. Not time to panic. You don't need to panic. That's not a panic situation. So, and with regards to the NASDAQ, again, the NASDAQ is the tech stock. The NASDAQ's done a little bit worse. The NASDAQ is down about 11% year to date. So the NASDAQ is in official correction territory. If you'll recall, correction is a 10% drop. And so the NASDAQ is officially in correction territory. The S&P is not there yet. Will it get there? Will it not? I don't know. No one knows. But I think it's likely. I think it's likely that we have some more problems ahead. So that takes us to our second question, because it is a quick market update. And we're going to talk about what you should do here in a little bit. But the reality is I think we could have more volatility. I think the market could go down from here. And yet the way you're all invested, it's really not going to affect you at all. We'll come back to that. But that's the reason why the stock market's having these problems. It all goes back to the labor market and the bad jobs report that we got last week. That's kind of what started this slide. So the next question we want to answer is what is the Federal Reserve going to do? Are they going to do an emergency rate cut? Well, the funny thing is that's what the Federal Reserve is asking. I'm sorry, that's what the media is asking. I've seen several headlines pop up on my phone. Emergency rate cut, and it's all this emergency. That's one of those buzzwords that, when you hear it, your heart starts to beat fast, right? And you're like, oh my gosh, they got to do an emergency. The Federal Reserve doesn't need to do anything. They shouldn't do anything. What they're going to do, no one can say for sure, but it'd be a mistake if they did an emergency rate cut because they're manipulating the economy. The biggest challenge I have with the Federal Reserve that just last week said that they're going to leave everything the same and they're probably going to cut rates in September is they're trying to artificially manipulate the economy, and that's what happens. It's a normal process. Every 6 weeks they meet, they go through the FOMC meeting, and they decide what they're going to do with the rates, and that's a great way to control the economy. And if they're doing an emergency rate cut, which they can do anytime they want, they don't have to wait for the FOMC meeting in order to do the emergency rate cut. They can do it anytime they want, but then it's called an emergency rate cut. Well, if they're going to do an emergency rate cut, it's got to be because there's an emergency. If a plane's going to have an emergency landing, it's got to be because there is a emergency. There's no emergency here. If the Federal Reserve does that, what it's going to do is it's going to pass on that recession brain, that recession effect. And if people think there's going to be a recession, it becomes a self-fulfilling prophecy. Oh my gosh, there's going to be a recession. Let's sell everything. And then that exacerbates the problem. It becomes a self-fulfilling prophecy. And if the Federal Reserve does an emergency rate cut, they're basically jumping on the bandwagon and saying, yes, there is an emergency, and they're kind of solidifying what the media is reporting. So there's been no talk, as far as I know, from the Federal Reserve that they're going to do an emergency rate cut, but there's a lot of talking around as to whether they will do that. Now, we do know, or we have a good indication that the Federal Reserve is going to cut rates. The fact is that over the last 6 months, again, in talking about interest rates and talking about the Federal Reserve, I have mentioned multiple times that the Federal Reserve has to have a reason to cut rates. They can't just cut rates because they want to. They have to have a reason to cut rates. And now all of the economic data is giving them a reason to cut rates. So I think that there's going to be at least a 1/4 point rate cut in September. Because of this recent decline in the stock market, maybe it's going to be a 1/2 point rate cut. But ultimately, they're going to cut rates at some point and keep them a little bit lower and then do what they need to from there. So, are they going to have an emergency rate cut? I hope not, but who knows? And it does also depend on what happens. The market's gone down 8.5% in the last 3 days. What if it goes down another 8.5% in the next 3 days? Well, then maybe an emergency rate cut is going to be required. But based on the recording of this video, which is August 5th, then an emergency rate cut right now is absolutely not required. So we'll see what happens. What does that do to your portfolio? And the only thing that I'm going to remind you of at this point is that most of you are invested for fixed income. Matter of fact, all of you are invested for fixed income. And if you remember anything from my previous videos, or if you've had a chance to read my book, More Life Than Money, and by the way, I'd recommend getting a copy of that book. You go to Amazon and buy it. You can call us. We'll send you a copy. But Amazon.com, the book is More Life Than Money. And the bottom line is that in the book, we talk about this and how do interest rates affect fixed income. Well, if you're invested for fixed income investments tend to react opposite of the stock market and of interest rates, right? Particularly interest rates. So if interest rates go up, fixed income investments tend to come down. If interest rates go down, fixed income investments tend to go up. Regardless of that fluctuation, though, and your fixed income investments are going to fluctuate, your portfolios, you've seen them fluctuate, the key ingredient, though, is that your income is going to stay the same. Your interest and dividends is going to stay the same regardless of that fluctuation. So whether it goes down or whether it comes up, if you're living on the income or you're reinvesting the income, then it really doesn't matter. But when interest rates come down, fixed income portfolios tend to go up. So as the Federal Reserve starts to lower interest rates, you're probably going to see the bottom line on your portfolio start to creep up a little bit as well. But again, it really doesn't matter whether it goes up or whether it goes down. Now, I want to talk briefly, because so far we've given you a quick market update. We've answered the question, what's the Federal going to do? What's am I talking fast or is it just me? Is the Federal Reserve going to lower interest rates or do an emergency rate cut? So we answered that question. I want to talk now a little bit about value stock and growth stock. And this is something that is relevant to what's going on now, but there are some questions over the last year that we have gotten from clients that have to do with this. So this question is going to tie in some of what's happened in the last year to presently what you can expect as well too. So when we talk about the stock market, broadly speaking, you can divide stocks into two camps, growth stocks and value stocks. A growth stock is a company that you're generally going to pay a premium for. The price for earnings is generally going to be at a very high multiple. It just means that the stock is expensive because you expect that company is going to grow into the stock price. You expect that company is going to have so much growth that you're willing to pay an excess premium for it so that as the company continues to grow, then eventually you'll wind up making money. That's a growth stock. Growth stocks are generally newer companies that are more growth oriented. And there's also a lot more volatility with growth stocks than maybe value stocks as well too. So that's growth stocks. You pay a premium for a stock that you think is just going to very much accelerate into the future with their growth. Well, the other option is a value stock. A value stock is a company that is generally more established. It's not so much a growth company. It doesn't mean it's growing, but when you have a company like ExxonMobil or Johnson & Johnson or Colgate or Procter & Gamble or something like that, you have a company like this, well, they're not growing in the same fashion that Amazon is growing or Google is growing or Facebook, right? You have a company that's been around for a long time. It's already been there. It's already done that. It's got growth, and it's going to wind up paying dividends. So value stocks are stocks that you're not going to pay a premium for, but stocks that you're hoping to even buy at a discount. Stocks that for some reason just have not, the price of the stock is just not caught up to where it should be for some reason or another. And when you buy a value stock, you're going to buy it at a price that you think is lower than what it should be worth, and then hope that stock price catches up to the actual value of the stock. So a growth stock, you're going to pay a premium, you're going to pay more, and you're going to hope that the company stock grows into the price of the actual company or into the price that you actually paid for it. But with the value stock, you're going to underpay for it, and you hope that the stock price grows into the value that the company is already worth, Not the value that it's going to grow to, but the value that it's already worth. So what are the subtle differences there? Well, the subtle difference is that growth stocks tend to be much more volatile. When the market crashes, growth stocks crash harder. When the market goes up, growth stocks go up faster. With growth stock continuing, growth stocks generally don't pay a dividend. Why? They're taking all their cash flow and they're growing. Amazon's using it to buy more trucks and buildings, right? They're doing some projects with drones now, try to get, drones delivering things to people. So everything that's there, that's the research and development, R&D, they're putting all that money back into that. They're not paying a dividend. They're growing. Well, value stocks, because they've been there and done that, and they don't have the same level of growth, the fact is that they're going to pay a dividend. So value stocks tend to be greater companies that have been around longer and companies that are going to focus on dividend and pay dividends. So when you buy a value stock, these companies tend to be more stable. They don't go up as much. They don't go down as much. And you might hear the media talk about a rotation that happens because if you look back at the last 100 years of history and you say, well, what's been better, growth stocks or value stocks? Value stocks have outperformed growth stocks by around 2% or so over the last 100 years. Value stocks have been better. But there have been decades where the growth stocks have done better, and there have been decades where the value stocks have done better. Growth stocks tend to do better in a very momentum market. We've had a momentum market recently with all the AI craze and everything else, but even going back to 2009, 2010, we've been in a momentum market, and growth over the last 10 years has outperformed value by far, by a long shot. And yet what's going to happen is that seems to be shifting a little bit. If we're going to go into a recession, if we're going to go into an elongated time period where the market's just going to be flat, ups and downs, washing each other out, really no significant growth like we've had for the last 15 years, if that's going to happen, value stocks are likely to outperform growth stocks. So the market for the last 15 years, growth stocks have been it, but we expect that to shift at some point. Does that mean it's going to shift tomorrow when you wake up? No. Does that mean it's going to shift all at one time, one day at midnight? No. This happens in bits and pieces and little chunks over time. But I would guess, and a lot of our economists are guessing, that value stocks are going to shift and start outperforming, especially if we get into a recession, and especially if it's an elongated recession, a recession that's going to last over a period of time. But value stocks won't grow as much as growth stock. And so what's happened over the last couple of years, the S&P 500 has gone through the roof, and a lot of the value stocks which we have you in that are more conservative, that are paying dividends, haven't grown nearly as much. And we've gotten some questions as to, hey, why is my portfolio, why is the stock part of my portfolio not performing the same as the growth stocks? Well, you don't have the same level of risk, and you have that income that you're getting from the growth stocks as well. But it's a different classification of stock. It's not designed to grow as much as growth stocks at this point in time, but we're trying to be ahead of the curve and see if see if that changes. So bottom line is there's a difference there between value and growth stock. Growth stock is for companies that you overpay for at the time, hoping that they grow into that value. But if we start to have a recession and people realize, oh my gosh, I overpaid for this stock and now we're going to go into a recession, guess what? It's going to go through the floor, and we've seen that happen recently as well too. Value stocks are more stable companies. Companies have been there and done that. When you are in a recession, you want to be with a company that has a much longer track record than some of these shorter companies. And so they're going to continue, our goal is to put you into companies that continue paying dividends, so you're still getting the income from the value stocks. These are stocks that you underpay in value for, hoping that the value grows to what the stock price actually is worth. So hopefully that helps you understand the difference between value and growth stock. Let's move on to annuities. Okay, how does the recent market activity affect your annuity? Well, all of you have either a fixed annuity or an index annuity, or even an index annuity with some type of fixed component. And just as a reminder, there's two kinds of index annuities out there from the way I'm going to categorize them. You've got index annuities that are designed to try to maximize interest, and index annuities that are designed to try to maximize income. Now let's talk about the income one first, because if you have an annuity that's designed to maximize income, then we don't really care what the interest is anyway. It's all about the income. And I don't want to take time, and the purpose of this This video is not to give you a seminar on how the annuities work. Matter of fact, I just did a podcast about that. And if you want to be reminded of how annuities work, go back and listen to that podcast. You can do that by going to providencefinancialpodcast.com, or you can just search for the Providence Financial Retirement Show on your preferred podcast player, and you can just go ahead and listen to the podcast that way. But the reality is that I just did a full podcast on annuities, and I've done several of them over the years. So if you go to providencefinancialpodcast.com and you type in annuities in the search, what's going to happen is several of them will pop up. Listen to those. Those will remind you of how annuities work. But with regards to income annuities, it doesn't even matter what interest you earn. I don't care if you earn any interest at all, because it's all about the income. It's not about the interest. So whatever's happening in the stock market now doesn't affect you in any way, shape, or form if you have an income annuity. But what about if you have an interest annuity, an annuity that doesn't give you that lifetime income, an annuity that you have there really for safety, but with the idea that you're going to get more income than more interest rather than normal, which is why most of you have done an annuity for interest. Well, the way that annuity works is when the market goes up, you're going to earn more interest than you would maybe at the bank. If the market goes down, you're not going to earn any interest, but you're not going to lose any principal. And there are several formulas in there that use specific dates to determine how much interest you're going to earn. And again, I don't want you I don't want to make this an annuity seminar. But the reality is that if your timing is bad and one of your dates, your contract anniversary happens to be last Thursday or Friday or today or any major down day, it's going to affect your annuity performance. So we don't know what's going to happen. I remember in the last month, I've had conversations even a month ago where, we've been looking at where the annuity is at year to date. We might be looking at an 11-month summary form that says this is where you are. If the market were to close today, this is how much interest you would have earned. And barring anything that would happen, assuming that we don't have a major crash, then this is what your annuity is going to be projected. Well, guess what? I wouldn't define what we've had as a major crash. But the fact that the market's down 8.5% in the last 2 weeks, that's going to affect your annuity returns, especially if your timing is really bad. Now, if your timing is a little bit better, if the market bounces right back, and your annuity date isn't on one of these particular dates, then the fact is that you might skirt around it. So we don't really know, but this market drop, could actually affect the actual amount of interest that your annuity is going to give you. But the good news is this: you're not participating in any downside. You can't lose money with the annuity, and that's the reason that we do the annuities, so that you have your money safe in something that is ironclad. So bottom line is that what's happened in the market in the last few days could affect the amount of interest that you earn in your annuity, but in no situation can you go negative. That's the whole point of the annuity. You get good returns on the upside, but no downside loss when it comes to market risk. So wanted to give you that quick update as far as the annuities, just as a quick reminder. What's the last thing? Well, the last question, do you need to do anything? Well, I think the answer in a nutshell is yes. What's the first thing you need to do? And that is not panic. We're not in panic mode, but I've had some of you panic when you shouldn't be panicking. And so there are some people that tend to panic if your portfolio goes down by 0.5%. Don't panic. This is not a panic situation. Matter of fact, I just did an interview earlier today. I think I mentioned that before. And in several interviews that I've done over the last 6 months, some of what I've said is that if you're invested right, you shouldn't be in a position to ever have to panic. I want you in a position to be able to win no matter what. And because you're all invested for income, you all have the ability to get income from your portfolio, and you're either all getting that income or you're reinvesting that income. If you're collecting your income, it doesn't matter what the market does. It doesn't matter if the market drops 50%. Emotionally, you might be looking at it and starting to sweat a little bit, but you're still going to be getting your income. And as long as you can get your income, you can still do the things you want in retirement. I don't want you to retire I don't want you to retire only if the market does well. I don't want you to only be able to travel and spend the money only if the market does well. And that's the whole point of investing for income, is you're living off the income of your portfolio so you can travel and do the things you want to do no matter what the market does. So the first thing is, don't panic. And if you're living off your income's going to stay the same. If you are not living off your income, you're invested with us for income, but you're reinvesting that. Well, if the market goes down, then you get to buy more shares for the same dollar because you're reinvesting the interest and dividends. So that helps you. It doesn't hurt you. So I think that's important to just say, don't panic. Now, some of you have other financial professionals that are managing maybe a growth portion of your portfolio. For most of our clients, for most of our client base, we're their only advisor. But some of you do have multiple advisors. You've got us maybe for the conservative portion, for the income portion, you have a growth advisor, or, more common than that is that you're doing it yourself with some portion of your money. Now, if you've got a chunk of your money in growth stocks, and your portfolio is down 8 or more percent from that, depending if it's NASDAQ driven, you might be down 10 or 15%. If you find yourself in that position and you're starting to panic there, then we're here to help. If you want to call us and have a conversation about, hey, I'm done with this, I can't stomach it anymore, I want to take this money that you've been managing on your own and let us help you with it, then feel free. Just call us, reach out to us, talk to me, talk to Tuan, and we can help you make that shift so that you can put yourself in a position not to lose sleep anymore, depending on what the market does. So, we can certainly, help you with that as well too. So don't panic. And is it a time for you to sell? No, that would be probably panicking. If anything, there are a number of you that have indicated that when the market crashes, or if the market goes down or has a correction, you actually want to buy more stock. Over the course of the last year and a half or two, when I've had conversations with you and we've taken you on as a new client, I have personally said that what I want it to do is I want to make sure that if we have another correction or recession, that you have the ability to buy more stock. And right now, the market's almost in correction territory. We're down 8.5% on the S&P 500. I think it's not a bad time if you want to add a little bit more to your portfolio, to your stock portfolio. I think it's not a bad time to do that. Everything right now is on sale by 8.5%. Now, what I would not do is I would not go all in. I would not say, okay, this is the time and we want to put this amount and that's everything. I would not do that. But if you want to add a little more to the stock portion of your portfolio and buy the dip, I don't think it would be a bad time to do that. So if that's something you want to do, reach out to us. Send me an email. Send Tuan an email. Tuan will probably be the one that's in touch with you about that. Tuan and I are always talking. But whenever I do a video like this, we often get dozens of people that are asking questions. So, either way, one of us will make it happen. But just bear with us as we, we get back to you. And we'll certainly get back to you. So there are 5 things that we covered in this video. The first thing that we covered is we did a market update for you. The second thing we did is we answered the question, is there going to be an emergency rate cut? The third thing is we talked about value stock and growth stock. I hope you have a better understanding of that. The fourth thing is we talked about annuities and the fact that the recent market action could actually affect the rate of return you get on your annuity if you have bad timing. And then the fifth thing is, do you need to do anything? The answer is yes. Don't panic. And then with regards to those of you that might be, using this or thinking that you should use this as an opportunity to buy a little bit more, I would agree with you. I think it's a good time to add a little more exposure to more value stocks, the stocks that pay dividends, to your portfolio. If you want to do that, call us, email us. We will get back in touch with you. I certainly hope this has helped. And again, I want to talk about my book. If you haven't bought my book, More Life Than Money, feel free to go buy it. Or if you call us, we'll give it to you. We just need to know you want it. And then also my podcast. There's, I think we're coming up on 400 episodes, and all of the episodes have to do with retirement and everything you need to know to make sure you have a peaceful and stress-free retirement. That's our goal. That's why we're here. Thank you for your trust. Thank you for your business. Any questions, feel free to call us. God bless.